Right now, 88.2 million households in America are priced out of buying a home. And if you've been telling yourself, I just need to save a little more, or maybe next year the market will cool down, I need you to hear this. The math has changed. And unless you understand exactly how it's changed, you could spend the next decade waiting for a moment that never comes. So let's break down who can actually afford to buy a house in 2026, what income you really need, and what moves the people who are getting in are making that everyone else isn't. Here's the headline number. The median home price in the U.S. right now sits around $357,000 for existing homes and roughly $413,000 for new construction. Mortgage rates just dipped below 6.1% for a 30-year fixed, which sounds like progress until you realize that 5 years ago, people were locking in rates under 3%. That difference isn't small. On a $350,000 loan, the jump from 3% to 6% adds over $700 to your monthly payment. That's $8,400 a year just in extra interest, going straight to the bank instead of building your equity. Now, here's where it gets personal. According to the National Association of Home Builders, you need a household income of at least $106,000 a year to qualify for a median-priced new home. But the median household income in America is only about $84,000. That means the typical American family falls short by more than $22,000 a year. And it gets worse. 65% of all U.S. households can't afford a median-priced new home. Nearly 2 out of every 3 families are locked out. And here's a detail that should make you angry. Every time the median home price rises by just $1,000, another 156,000 households get pushed out of the market. That's not a crash. That's not a recession. That's a single $1,000 price bump erasing the eligibility of a mid-sized American city overnight. The affordability window isn't slowly closing. It's slamming shut in increments so small most people don't even notice until they sit across from a loan officer and hear the word denied. So who is buying? 3 groups are making it work, and their playbook is worth studying. The first group is dual-income households with no kids, or at least no kids yet. When 2 people earning $55,000 each combine their income, they hit $110,000, which puts them right at the threshold. They're not rich, they just have the math on their side, because 2 incomes servicing 1 mortgage payment is the single biggest advantage in this market. The second group is people buying in overlooked markets. Right now, cities like Rochester, New York, have a median listing price of just $139,900. Pittsburgh is around $250,000. Birmingham, Alabama, St. Louis, Indianapolis. These aren't broken cities. These are places with real job markets, growing populations, and homes that a household earning $65,000 can actually afford. The people who refuse to look beyond their expensive zip code are the ones staying stuck. The third group is people using every program available and not being too proud to ask for help. FHA loans still let you get in with as little as 3.5% down. VA loans require 0 down. USDA loans in qualifying rural areas also require 0 down. And there are more than 2,000 down payment assistance programs across the country. Yet, a NerdWallet survey found that only 37% of Americans even know a 20% down payment isn't required. Now, there's a hidden force keeping this market tight that nobody talks about enough. It's called the lock-in effect. Millions of homeowners locked in mortgage rates between 2% and 4% during the pandemic. Why would they sell and take on a new mortgage at 6%? They wouldn't. and they're not. Homeowners are staying in their homes for the longest stretch in at least 25 years. That means fewer homes hit the market, which keeps inventory low and prices high, even when demand slows down. Here's something that might sting. According to Realtor.com's analysis, for housing to become as affordable as it was in 2019, one of three things would have to happen. Mortgage rates would need to drop to 2.65%. That's not happening without another global crisis. Median household income would need to jump to $132,000, a 56% raise. That's a fantasy. Or home prices would need to fall 35%, dropping to around $273,000. Prices haven't fallen like that since 2008, and the conditions that caused that crash don't exist today. 30 million homeowners don't even carry a mortgage, and those who do have record levels of equity. There's no wave of forced selling coming. So what do you actually do with this information? Step 1. Stop waiting for the market to rescue you. It won't. Prices are projected to rise another 1 to 4% this year, depending on the market. Every month you wait, you need more income to qualify. Step 2. Get brutally honest about your numbers. Use the 28-36 rule. Your housing payment should stay under 28% of your gross monthly income, and your total debts under 36%. If you earn $85,000 a year, your max monthly housing cost is around $1,983. Work backward from there. Step 3. Attack your debt before you attack the housing market. Every $500 in monthly debt payments reduces your mortgage approval by roughly $75,000 to $100,000. Paying off a car loan could literally be the difference between qualifying and getting denied. Step 4. Expand your map. The people getting into homes right now aren't all buying in the cities they grew up in. Remote work has changed the game. A $75,000 salary goes nowhere in San Francisco, but it buys you a solid 3-bedroom in a dozen thriving mid-sized cities across the Midwest and South. Step 5. Stack every advantage. First-time buyer programs, state-level grants, employer-assisted housing benefits, seller concessions. These exist, they're real, and they're being left on the table by people who never bother to ask. The housing market in 2026 isn't impossible, but it is unforgiving to anyone without a plan. It rewards people who move with strategy, not emotion. People who study the numbers, get creative with location, and treat home ownership like a financial operation, not a daydream. You don't need a 6-figure salary to buy a home. You need a 6-figure strategy. And now, you have the blueprint. If this changed how you see the housing market, subscribe to Frankie Finance. We break down the money game so you can stop watching from the sidelines and actually get in. Thanks for watching, and I'll see you in the next one.